macro currency signals.
What I am about to lay out before you is not a headline crafted for clicks. It is not a dramatic exaggeration designed to stir emotion. It is a structural reality unfolding in real time. All the silver you assume is sitting comfortably in vaults, warehouses, and exchange inventories is not what you think it is. The visible supply is a shadow of the true condition. The foundation beneath the global silver market is eroding, and most people have no idea it is happening. We are living through the early stages of what can only be described as a mass extinction event for available silver. Not extinction in the geological sense, but extinction in terms of freely accessible, deliverable, above-ground supply. The kind that can be purchased without delay, the kind that can be delivered without excuse, the kind that underpins trust in the pricing mechanism itself. Before we move forward, if this message is resonating with you, take a moment to subscribe and turn on notifications. In an environment like this, timing isn't just useful, it's leverage. Getting positioned early rarely feels comfortable. It's seldom the popular move. But that's exactly where the greatest asymmetry exists. Leave a comment below and share where you're watching from and what time it is where you are. This conversation isn't confined to one country, one currency, or a single exchange. It's unfolding worldwide, and when you start to see how widespread these signals are, you realize this is much larger than any isolated headline. Now, let's return to the quiet transformation happening beneath the surface. For decades, silver has been treated as an afterthought, overshadowed, underestimated, mispriced. While attention has been directed elsewhere toward technology booms, real estate cycles, digital assets, bond yields, the quiet metal has been moving through a different arc. An arc defined by depletion, consumption, and concealment. Let's begin with the most fundamental truth. Silver is being consumed at a rate that exceeds sustainable replenishment. Unlike monetary assets that simply change hands, silver disappears into industrial applications. It is built into the circuitry of modern civilization. It is fused into solar infrastructure. It is embedded into vehicles, electronics, defense systems, medical devices, and energy grids. Once dispersed across millions of products, it is not easily recovered. In many cases, it is economically impractical to recycle. Every year, ounces leave the ground. Every year, more ounces are demanded. And every year, the buffer between supply and demand becomes thinner. Mining output is not responding the way many assume it can. New, large-scale discoveries are rare. Ore grades have declined over time. Development timelines stretch across years, sometimes decades. Regulatory pressure increases. Capital discipline tightens. Extraction costs rise. Mines that once yielded abundant silver now produce less. Many silver operations are not even primary silver mines, they are byproducts of other metals. That means silver supply is tied to decisions made in entirely different markets. This is not a dynamic that can be reversed overnight. You cannot will new silver into existence. You cannot print it. You cannot digitally replicate it. You must find it, extract it, refine it, transport it, and distribute it. And that chain is under strain. At the same time, industrial demand is not slowing. The global push toward electrification requires silver. High-efficiency solar panels require silver paste. Advanced batteries, charging systems, and power management components require silver. Precision medical equipment requires silver. Communication infrastructure requires silver. This is not optional demand. It is structural demand tied to long-term technological transitions. Now layer on investment demand. In periods of monetary uncertainty, capital rotates toward tangible assets. Silver has a dual identity. Industrial metal and monetary metal. That combination is powerful. It means silver is pulled from both sides, consumed by industry and accumulated as a hedge. When inflation erodes purchasing power, when real interest rates fall below zero, when currency confidence weakens, individuals and institutions begin to seek assets outside the fiat system. Silver answers that call. It is divisible, it is recognizable, it carries historical monetary legitimacy, and here is where the disconnect becomes critical. The price displayed on financial screens does not fully reflect physical scarcity. The paper market for silver is many multiples larger than the physical market. Futures contracts, derivatives, exchange-traded instruments, these create synthetic supply. They allow claims on silver to be traded in volumes that dwarf actual deliverable inventory. As long as confidence remains intact, this structure appears stable. Participants roll contracts forward, positions net out. Few demand delivery, the illusion holds, but the illusion depends on behavior. If enough participants decide they want metal instead of paper, the ratio between claims and ounces becomes exposed. When that exposure happens in a tight supply environment, price repricing is not gradual, it is abrupt. This is why the term mass extinction is appropriate. Because what disappears first is not silver in the ground, it is available silver in the market. It is the float, the freely tradable supply, the buffer inventory that absorbs shocks. Once that buffer is gone, volatility becomes extreme. Consider the psychological dimension. For years, silver has been perceived as plentiful, affordable, secondary. That perception suppresses urgency. It encourages complacency. But perception can flip rapidly when scarcity becomes visible. Empty shelves at retailers, delayed deliveries, rising premiums, withdrawal limits, contract settlement stress. When confidence shifts from abundance to shortage, behavior changes. Buyers accelerate, holders refuse to sell, suppliers ration, prices gap higher, markets move slowly until they don't. There is also a strategic element unfolding quietly. Large pools of capital understand structural imbalances long before they become headlines. Accumulation does not announce itself with fanfare. It happens incrementally, steadily, off-market, through private transactions and long-term storage arrangements. When metal moves into strong hands, it rarely returns quickly. It tightens the tradable pool. It increases sensitivity to marginal demand. And then there is the broader monetary backdrop. We are operating in a world defined by unprecedented debt levels. Sovereign balance sheets are stretched. Currency supply has expanded dramatically over the past decade. Real yields have been suppressed. Liquidity cycles have distorted asset pricing. In such an environment, tangible assets, with finite supply, become strategic insurance. Silver's market capitalization is small relative to global financial assets. That is crucial. It means that even modest capital reallocation into silver can create outsized price impact. The pool is shallow compared to equities, bonds, or real estate. When demand surges into a small market with tight physical supply, the repricing mechanism can be violent. This is not theoretical. It is mechanical. Add to this the structural delay in supply response. Even if prices rise sharply, new mining supply cannot appear instantly. Projects require exploration, permitting, financing, construction, and ramp-up. Years pass. During that window, demand continues. That is how exponential moves form. The extinction event is therefore not a single day or a single spike. It is a transition phase, a shift from artificial equilibrium to physical reality, from paper dominance to delivery preference, from complacency to urgency. Many will not see it coming because they are looking at charts instead of inventories, at headlines instead of logistics, at price instead of flow. When industrial users begin competing more aggressively for supply, when investment demand collides with production constraints, when delivery pressure stresses derivative markets, the narrative changes. And once the narrative changes, capital moves faster. The revaluation of silver will not be polite, it will not provide extended warning. It will unfold in waves, each wave forcing reassessment. Those who dismiss the possibility assume continuity. They assume the system functions indefinitely, as it has. But systems under strain break at the margin first. A delayed shipment, a missed delivery, a temporary suspension, a widening premium. Small signals precede large shifts, and when the shift becomes undeniable, access narrows. This is why timing matters. Not in the sense of predicting the exact day, but in understanding the phase transition. We are not at the beginning of abundance. We are near the exhaustion of slack. Every ounce acquired now removes one more ounce from circulation. Every ounce consumed industrially is one less ounce available for monetary demand. Every year of underinvestment in supply compounds the imbalance. The extinction event is the culmination of these compounding pressures. And here is the deeper implication. When silver reprices, it does more than reward holders. It signals stress within the monetary system. It reflects currency dilution. It exposes leverage. It forces reevaluation of asset allocation strategies across portfolios. Silver does not move in isolation. It moves as part of a broader financial recalibration. Part 1 of this story is recognition. Recognition that the visible calm masks structural fragility. Recognition that supply constraints are real. Recognition that paper representation is not physical possession. Recognition that small markets with big imbalances produce outsized outcomes. The silver extinction event is not a fantasy scenario. It is the logical endpoint of years of underappreciated fundamentals converging simultaneously. Supply contraction, industrial acceleration, monetary uncertainty, paper leverage. When these forces intersect, price becomes a lagging indicator. We are standing at the edge of that intersection, and most people are still looking the other way. At first, the shift is subtle. Industrial buyers begin locking in longer-term contracts. They extend supply agreements. They reduce reliance on just-in-time inventory models. Quietly, they increase reserves. Not publicly, not dramatically, but enough to remove incremental ounces from the open market. Then investment demand strengthens. Not speculative day trading. Not short-term momentum chasing. Strategic allocation. Wealth-seeking insulation from monetary distortion. Capital looking for something finite in a world of expanding balance sheets. When these two forces, industrial security and monetary protection, compete for the same shrinking pool of available metal, the market enters a new regime. Price discovery becomes unstable. In a normal commodity cycle, higher prices incentivize production, and production eventually balances demand. But silver does not behave like a typical commodity. Much of its supply is a byproduct. That means higher silver prices do not automatically generate proportional new output. Production decisions remain tied to other metals. Supply elasticity is muted. So when demand increases in this environment, the pressure does not dissipate easily. At the same time, the paper market structure begins to feel strain. Large open interest relative to deliverable supply works smoothly only when most participants settle in cash or roll contracts. But if confidence in paper claims weakens, even slightly, more participants may request physical delivery. This is where leverage becomes dangerous. When multiple claims exist for each ounce, the system depends on low conversion rates from paper to physical. Increase that conversion rate, and the imbalance surfaces immediately. Warehouses drain faster than expected, inventories that appeared sufficient begin to look thin, settlement mechanisms face pressure. This does not require panic. It only requires incremental change. A small percentage shift from paper preference to physical preference can cascade rapidly, and once a delivery squeeze begins, pricing dynamics transform. Premiums detach from spot. Retail markets disconnect from exchange quotations. Delays expand. Rationing appears. The narrative shifts from plenty available to limited supply. Psychology flips. Markets are not purely mathematical. They are behavioral. When confidence in abundance disappears, urgency replaces patience. Buyers who once waited for pullbacks begin chasing availability. Sellers become reluctant. Liquidity thins. This is how vertical price movement forms. And because silver's market capitalization is relatively small compared to global capital pools, it does not require enormous inflows to produce dramatic price effects. A fraction of institutional reallocation from bonds, equities, or cash equivalents into physical silver would overwhelm available supply. That is the asymmetry. On the downside, silver appears stable for long periods. On the upside, when the structural imbalance expresses itself, moves can be multiples of prior price ranges. History has shown that when silver runs, it does not crawl. It surges. But this time, the backdrop is different. Global debt levels are higher. Currency creation has been more aggressive. Industrial demand is structurally stronger. Supply constraints are more mature. The derivative structure is more complex. In other words, the fuel load is larger. Consider the monetary context. Persistent fiscal deficits require financing. Financing often requires monetary accommodation. Monetary accommodation suppresses real yields. Suppressed real yields push capital toward alternative stores of value. Silver becomes not just an industrial necessity, but a monetary statement. When purchasing power erodes gradually, many ignore it. But when inflation becomes embedded, when cost of living pressures intensify, when savings yield less than price increases, behavior shifts. Hard assets regain attention. The extinction event in silver intersects with this monetary awakening. As more participants recognize that physical metal is finite and paper currency is expandable, the preference for tangible assets strengthens. That preference does not need to become universal to move price. It only needs to grow marginally. Now, layer in geopolitical uncertainty, trade tensions, resource nationalism, strategic stockpiling, supply chain fragility. These forces encourage governments and corporations to secure critical inputs domestically or through long-term contracts. Silver is classified as essential for modern infrastructure. If access becomes uncertain, preemptive accumulation becomes rational. That accumulation tightens global float even further. The mass extinction event, therefore, is not a dramatic overnight disappearance. It is the progressive locking away of available supply until the remaining float cannot absorb normal demand variability. When that threshold is crossed, volatility becomes the new normal. Sharp upward repricing episodes will not necessarily reverse quickly, because unlike speculative bubbles built on narrative alone, this move would be anchored in physical constraint. Short sellers in a structurally tight market face risk asymmetry. Losses are theoretically unlimited. If delivery stress intensifies, covering activity can accelerate upward momentum. Feedback loops form. Higher prices attract attention. Attention attracts new buyers. New buyers tighten supply further. Tight supply supports higher prices. At some point, price levels previously considered unrealistic become reference points. Then new targets emerge. But it is critical to understand, the opportunity does not lie in chasing headlines. It lies in recognizing structural shifts before consensus forms. When mainstream recognition arrives, repricing may already be well underway. Preparation, in this context, is not speculation. It is strategic positioning. It is understanding counterparty risk. It is distinguishing between paper exposure and physical ownership. It is evaluating liquidity access. It is considering storage, security, and allocation discipline. The extinction event rewards foresight and penalizes complacency. Because when shortages become visible, accessibility narrows. Premiums expand, secondary markets tighten, regulatory responses may emerge. Transaction friction increases. Those who waited for confirmation often find confirmation expensive. There is also a broader wealth transfer dimension. Assets tied to fiat systems may struggle in high inflation or currency debasement cycles. Tangible scarce assets can outperform significantly during these transitions. Silver, given its dual role, sits at a crossroads of industrial indispensability and monetary resilience. That combination is rare. Many commodities are cyclical. Many monetary assets lack industrial utility. Silver bridges both worlds. That bridge amplifies demand convergence during systemic stress. The mass extinction event, therefore, is a revaluation catalyst. It challenges assumptions about abundance. It challenges trust in paper leverage. It challenges complacency around supply chains. It challenges traditional portfolio construction. When markets transition from confidence to constraint, the rebalancing is not polite. We must also confront a difficult truth. Systems built on leverage function smoothly until they don't. When strain accumulates quietly over years, release events can appear sudden, but they are rarely random. They are the visible manifestation of invisible pressure. Silver's structural pressures have been building for a long time. Underinvestment in exploration, declining ore grades, rising industrial intensity, monetary expansion, derivative leverage, inventory drawdowns. Individually, each factor may appear manageable. Together, they form convergence. Convergence produces inflection points, and inflection points redefine price regimes. For those observing closely, signals accumulate, rising premiums relative to spot, increasing delivery volumes, warehouse outflows, contract positioning shifts, industrial procurement changes. These are not isolated anomalies. They are indicators. When enough indicators align, probability shifts. Part 2 of this message is clarity. Once the extinction event becomes widely acknowledged, positioning windows narrow dramatically. Liquidity favors the prepared. The goal is not panic. It is awareness. It is understanding that in markets driven by finite supply and expanding demand, time works against late entrants. Silver's repricing potential is not linear because constraints are not linear. At low stress, price drifts. At moderate stress, price trends. At high stress, price gaps. We are approaching high-stress conditions, and when the revaluation unfolds, it will not ask for permission. It will not wait for comfort. It will not align with consensus expectations. It will simply reflect reality. The extinction event is the transition from illusion to exposure, from synthetic abundance to physical scarcity, from suppression to expression. And once expression begins, the scale of the move may exceed what current price anchors allow most people to imagine. That is not hyperbole. It is the arithmetic of tight supply in a small market facing converging demand forces. Those who understand this are not gambling. They are aligning with structural inevitability. Those who ignore it may find themselves reacting in an environment where reaction is costly. The silver market is approaching a phase shift, and phase shifts do not whisper. They erupt. So here is the final truth. This is not about chasing a price target. It is not about predicting a specific number on a screen. It is about recognizing a structural turning point before it becomes obvious to everyone else. The extinction event in silver is a shift in availability, a shift in psychology, and ultimately a shift in power. When a finite asset collides with expanding demand and monetary instability, the outcome is not subtle. All the silver you thought was plentiful is being absorbed, consumed, locked away, reclassified from commodity to strategic asset. And when the last layer of complacency peels back, when the paper illusion can no longer mask physical scarcity, the repricing will not be gradual. It will be decisive. History does not reward those who react late to structural change. It rewards those who recognize imbalance early and position accordingly. The window between quiet accumulation and public realization is where opportunity lives. Once realization spreads, opportunity narrows. The storm is not theoretical. The pressure is already built into the system. Supply is tight, demand is relentless, leverage is stretched, confidence is thinner than it appears. When silver moves, it will not ask who is ready. It will simply rise. And in that moment, the difference between preparation and hesitation will define outcomes.